And here on our news, it says Black Swan Capitalist says $10,000 XRP price isn't crazy because. So, the question right here is, why are institutional analysts telling investors to stop laughing at a five-figure XRP? So imagine looking at a tiny physical key that unlocks a massive vault containing trillions of dollars. If the key is the only thing that can open the door to move those funds instantly, how much is the key itself worth? It certainly wouldn't be worth pocket change. This is the exact mental framework we need to adopt today as a massive debate explodes across the digital asset space. A prominent financial analyst and founder of Black Swan Capitalist, Versan Aljarrah, right here, recently published a statement on X that has completely disrupted the usual market chatter. He is telling the financial world to completely stop laughing at five-figure price targets for XRP, specifically pointing to evaluation of $10,000 per token. While retail traders are bickering over cents and single-digit resistance lines, institutional minds are calculating what happens when macro-level necessity meets a fixed ledger supply. So in this video, we are stripping away the everyday hype to examine the mechanics of global settlement, asset scarcity, and capital efficiency. We will explore why the current market structure might be looking at XRP through the wrong lens entirely, and analyze the intense community reactions to this bold claim. So let's look directly at the data. So, how do trillions in instant settlement create an inevitable repricing? The core pillar of the argument shared by Versan Aljarrah right here rests on an institutional math equation. Utility multiplied by scarcity compounded by global adoption. So let's just highlight that part. The premise is straightforward. The current global financial architecture relies on trillions of dollars moving across borders every single day, trapped in slow, expensive legacy systems. XRP was explicitly engineered to serve as a high-speed bridge asset to settle these astronomical sums instantly. Now, here's my opinion. I have long maintained that evaluating XRP purely on retail trading volume is a fundamental mistake. When you look at the sheer scale of global liquidity, the current price reflects a market that is still treating this asset like a speculative tech stock rather than a foundational piece of global plumbing. If a bridge needs to support the weight of a trillion-dollar locomotive, the bridge itself must be constructed with a massive capital capacity. An ultra-low token price simply cannot support macro-level institutional settlement without causing massive liquidity shortages on the ledger. Now, why is the financial system facing a choice between retail speculation and institutional reality? According to the post shared on X, the mathematical reality is firmly on the side of a massive upward adjustment. When an ecosystem features a fixed supply of 100 billion tokens and a rising institutional demand requires moving trillions of dollars daily, the nominal value of each unit must adjust upward to handle the transactional volume. Retail speculation drives short-term volatility, but institutional reality dictates the long-term floor. Now, here's my opinion. The divide between retail expectations and institutional design is widening. Many everyday market participants are frustrated that the asset hasn't even sustained a move past $100. It hasn't even sustained a move past $100 yet, causing them to view a $10,000 target as pure fantasy. However, they are looking at organic retail buying power, which is finite. Institutional adoption operates on corporate treasuries and central bank liquidity, which operate on an entirely different order of magnitude. The math isn't broken. The market's patience is just being tested by the timeline. Now, what does a $41,000 theoretical ceiling reveal about tokenized real-world assets? The post on X triggered an immediate wave of intense debate within the digital asset community, splitting observers into distinct camps. One fascinating perspective highlighted in the community discussion cited an advanced AI-generated estimate. So let's just highlight this part. So this model suggested a theoretical price ceiling near $41,000 if the XRP ledger became the exclusive bridge asset for tokenized real-world assets worldwide. Now here's my opinion. While $41,000 sounds like an astronomical figure, thinking about it from a structural perspective reveals the logic behind the calculation. If real estate, gold, and debt instruments are completely tokenized onto a public ledger, the underlying asset facilitating those trillions of dollars in transfers must absorb that value. So my view is that while exclusive dominance is highly unlikely due to market competition, even capturing a modest 10% or 20% fraction of tokenized real-world assets makes a 4-figure or 5-figure valuation mathematically sound over a multi-year horizon. Now, why does a high token price improve capital efficiency rather than transaction speed? Among the waves of feedback to the Black Swan Capitalist post, a crucial technical clarification emerged from a conservative sector of the audience. A community member pointed out that the transaction speed of the ledger is already fixed at roughly 3 to 5 seconds. A higher price target, such as $1,300, $2,500, or $10,000, will not make the blockchain settle transactions any faster than it already does. Instead, it alters capital efficiency. Now, here's my opinion. This is perhaps the most critical distinction for any serious market observer to understand. A higher price does not accelerate the network. It optimizes how much money can move through it simultaneously. If one token is worth $1, moving $1 million requires 1 million tokens, which drains available liquidity from the market. If one token is worth $10,000, that same $1 million transaction requires just 100 tokens. This dramatic increase in capital efficiency is exactly why institutions would actually prefer a high-priced token over a cheap one, as it prevents market slippage during massive transfers. Now, what is the ultimate outlook for the global liquidity migration? When we synthesize the institutional thesis with technical feedback from the community, a distinct picture begins to take form. The debate is no longer about whether the ledger functions as intended, but rather how the macro financial system intends to utilize its fixed supply architecture. And finally, here's our overall conclusion. The thesis presented here by the Black Swan Capitalist founder shifts the conversation away from emotional retail hype and grounds it in structural mechanics. A $10,000 XRP price target ceases to look like an arbitrary, crazy number when it is evaluated against the multi-trillion-dollar scale of global cross-border payments and tokenized real-world assets. While the wider retail market remains heavily divided on the exact timing and the realistic near-term milestones, with mainly looking toward more immediate targets like $1,300 or $2,500, the underlying principle remains clear. If the institutional migration of the XRP ledger occurs as designed, the asset's valuation model must completely change from a speculative retail coin to a highly efficient capital bridge. The path forward will ultimately be dictated by true network utility and global infrastructure adoption rather than temporary social media sentiment. And this finally ends our video. Thank you very much for watching and see you on the next one, or you might just as well check this next recommended video right here.